Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. So you completed your Roth IRA conversion for 2025, or you are about to complete one before the December 31st deadline. And the question is, are you going to get dinged with underpayment penalties and interest? And the follow-up question is, if you are on track to get dinged, is there anything you can do about it before December the 31st or before April the 15th of next year to reduce or eliminate the ding? To answer these questions, let's walk through some IRS logic so that we can understand how the rules work and how to use those rules to our advantage. So here's Fred right down here, and Fred says, I had a $70,000 capital gain in December. Now take note right here that this could be a Roth IRA conversion instead of a capital gain. In fact, what we are talking about right here is any transaction where the income is generated on a specific date during the year. So more generally, Fred is saying I had a $70,000 income transaction, and that transaction occurred in December of the current year. Now let's go over here to the IRS logic. The IRS will say that gain was earned evenly between January and December of this year. Now Fred is like, no, you don't understand. Like, I literally sold my shares of XYZ company on December the 1st, 2025. And once again, we could have just as easily said that Fred performed a Roth IRA conversion on December the 1st, 2025. But either way, Fred is arguing the gain occurred in December. That is the date when it actually occurred. Now going back over here to the IRS logic, the IRS hearing that statement will say that gain was earned evenly between January and December of this year. Now Fred over here, he's getting a little bit feisty. That doesn't make any sense. The gain occurred on December the 1st when I actually completed the transaction. I have paperwork showing it was December the 1st. I even sent in my estimated tax payment for this transaction, which Fred determined to be the $70,000 capital gain multiplied by the 15% preferential long-term capital gain rate on December the 1st. He sent in his estimated tax payment on the very day when he completed the transaction. Now going over here to the IRS logic, the IRS will say your payment will be counted as being received on December the 1st. Now back to Feisty Fred over here, but you just said that my gain is going to be evenly spread out between January and December. So the December 1st payment won't be timely to cover the part of the gain that is deemed to occur between January and November, the first 11 months of the year. So therefore, I'm going to get dinged with underpayment penalty and interest for those 11 months because basically you spread out 11/12ths of my income into the first 11 months of the year, but you didn't count my payment, which was intended for the full $70,000 gain, until December the 1st. And going over here to the IRS logic, that is correct. Well, Fred is not having any of that. I am going to call the IRS helpline and see if I can get some solution to all of this craziness. To which the IRS logic will say, great, please take a number. And once you take a number while you're on hold with the IRS, we all know how that's gonna turn out. Okay, now what is the issue that is being discussed right here between Fred and the IRS? It's the issue of when the IRS recognizes various types of transactions as occurring. So right here, let's go over the IRS default treatment for the three main types of transactions that are going to be relevant to this discussion. Number one, the income that you generate and the expenses that you incur are deemed by the IRS to occur pro rata, meaning evenly throughout the year, regardless of when they actually occur. Withholding, like you would have on a W-2 or you would have with your broker if you complete certain kinds of transactions, withholding is deemed to occur pro rata as well, or evenly throughout the year, regardless of when it actually occurs. And then finally, estimated tax payments. Those are the tax payments that you can send in directly to the IRS. That is different than withholding on your paycheck or withholding by your broker on certain transactions. Estimated tax payments are treated as occurring when they actually occur. So once again, these three treatments right here are the default treatment of the IRS. All right, let's jump into some examples. And by the way, if you enjoy this video, please like and subscribe and consider hitting YouTube's all new hype button, which allows my viewers to hype a video within the first 7 days of its release. Hyped videos end up on a special list, which allows YouTube's algorithm to show the video to broader audiences and thus helps grow the channel. So if you're willing to help me out with that, it's much appreciated. Okay, let's kick off the examples with chart 1 right here. This is what most people think happens with their income and their estimated tax payments. So this is the example of Fred one more time. He had that $70,000 capital gain on December the 1st. He also made that estimated tax payment of $70,000 multiplied by 15%, which comes to $10,500, and he made that estimated tax payment on the same date that he had the capital gain. So as we talked about in the conversation between Fred and the IRS, this is what Fred thinks happens when he has that $70,000 capital gain. He thinks that all of the income is going to be in Q4 right here, and that the payment is also going to be in Q4. However, continuing the example with chart 2 right here, this is what the IRS will see, just like we discussed previously. The IRS will say that the $70,000 of gain is generated pro rata throughout the year, and therefore the IRS will see an even distribution of $17,500 of capital gain in Q1, the same amount in Q2, the same amount in Q3, and then the same amount in Q4. In addition, as we discussed before, an estimated tax payment by default will be treated as occurring when it actually occurred, so the estimated tax payment will be taken into account in Q4, just like we said above, but the gain or the income itself will be spread out evenly across the 4 quarters by default. Chart number 1 up here and chart number 2 are graphical representations of what we just went over in the discussion between Fred and the IRS. Now, continuing the example with chart 3, what if you did withholding instead of making an estimated tax payment on December the 1st? Well, withholding, as we discussed before, is also treated as being incurred pro rata by default. Therefore, if we pop back up here for just a minute, Fred made that $10,500 estimated payment in Q4. But if Fred had chosen to do withholding on this transaction instead of sending in an estimated tax payment, in other words, he had his broker withhold $10,500 and remit it on his behalf, then coming down here, the IRS would see this. They would see $2,625 of withholding as occurring in Q1, and then equal amounts occurring in Q2, Q3, and Q4. So just to summarize, while an estimated tax payment will be treated as occurring when it actually occurred, withholding will be treated as occurring pro rata regardless of when it actually occurred. So if that $10,500 had been withholding on December the 1st, it would not have mattered what date it occurred on. It would have been deemed to occur pro rata like this by the IRS. Okay, now going down here to chart 4, which is also the same as chart 1. Remember that chart 1 is what Fred thought would happen. He thought the income of $70,000 would be here in in Q4, and that the estimated tax payment would also be in Q4. He was right about the estimated tax payment, but he was wrong about the $70,000 of gain. That was treated as being pro rata, and it was spread out over the 4 quarters. However, now down here in chart 4, the question is, how do you make this scenario? In other words, how do you make this, what Fred originally thought was going to happen? How do you make this a reality? How do you make this what the IRS actually sees instead of their default treatment? And the answer is you elect the annualized income installment method on your tax return. This election makes the IRS see income as occurring when it actually occurs instead of the default treatment, which was the pro rata method. So if Fred was to elect the annualized income installment method, then the capital gain of $17,500 that was in Q1 and the same in Q2 and the same in Q3 are all going to be crossed off, and it's going to push all of the income back into Q4 where it actually occurred. So just to summarize one more time, what the annualized income installment method election does is it takes all of the income out of the pro rata default treatment and it pushes it to whatever quarter it actually occurred in. So with these concepts in mind, what are the 3 last resort ways to save your assets from those pesky underpayment penalties and interest? Starting right here, last resort method number 1, figure out how to generate additional withholding before December the 31st. So the question is, how can this be done? Now, possibility number 1 is that you create a transaction that allows your broker to withhold and remit the money on your behalf. For example, you could do another Roth IRA conversion, even if you have done 1 or more already in 2025, and you could have the broker do 100% tax withholding on the transaction. In other words, if you did a $10,000 Roth conversion just for purposes of what we're trying to accomplish right here, and you did that transaction with 100% withholding, then the broker would just submit the $10,000 as withholding to the government. None of it would be deposited into your Roth IRA because, again, we're using the full amount for withholding. But the key is that you would get credit of $2,500 paid in per quarter. So let's think about this strategy and why we would do it and how it works. This is a last resort withholding strategy. The rationale behind this strategy is that you discover you are underpaid in Q1, Q2, or maybe even Q3. So in other words, it is currently Q4. We are over here. The year is almost over. We're working on our Roth conversion planning, or we're working on our estimates for the year. And we discover, hey, back here in one or all of these quarters, we don't have enough paid in. We're going to get dinged with underpayment penalties and interest. And because these 3 quarters are already closed, there's usually not a whole lot you can do to fix a situation like that. You can't go back in time and make an estimated tax payment in a quarter that has already been closed. And so we really have limited ability to address those underpayments. However, one thing that we do have potentially is the ability to use the fact that the IRS treats withholding as occurring pro rata. Therefore, right over here, even out to the very last day of the year, December the 31st, if you do some withholding off of a transaction, for example, $10,000 is what we're using in this example, this may be the date right over here when you actually did the withholding, but because of the default rule, the IRS is going to give you credit for that withholding in all 4 of the quarters. Doing something like this will certainly allow you to reduce any dings, i.e. underpayment penalty and interest in the first 3 quarters. You're absolutely going to reduce it because you're going to get credit for $2,500 paid in here, $2,500 paid in over here in Q2, and then $2,500 paid in Q3. Whether or not you eliminate some or all of the underpayment penalty and interest will just depend on how underpaid you are versus how much withholding you choose to do. It is certainly possible that with enough withholding, you could eliminate the underpayment penalties and interest entirely, although based on many other facts and circumstances in your financial situation, you may not want to engage in a transaction that's large enough to create the necessary withholding to eliminate the underpayment penalties completely. completely, but you certainly could reduce them significantly by doing something like this. It's all just going to depend on the numbers when you sit down and lay them out. But the key concept here and the takeaway that I want you to have is that we can use that default rule of withholding being spread out to all the quarters to our advantage even after the fact, even after Q1, Q2, and Q3 are closed. If we decide to engage in a transaction where we can have withholding completed out here, we can get credit for it in these closed quarters back here. Take note, by the way, that this strategy must be completed before the year is over. You can't do withholding after December the 31st. Like, let's say this is 2025 right here. You can't do withholding out here in 2026 and expect it to apply to 2025. So if you are going to engage in a strategy like this, it must be completed by the last day of the year. Okay, possibility number 2 to accomplish this strategy. Let's say that you can't get the withholding done through the broker for whatever reason. In that case, possibility number 2 is if you are still currently employed, you could ask payroll at your company to withhold, for example, your entire last 1 or 2 paychecks for the year. Because remember that withholding is withholding. It doesn't matter the source of the withholding, all withholding gets lumped together. So if you can't complete the withholding transaction at the end of the year through the broker, it's possible you might be able to get some or all of it done through payroll at work. How much they're willing to withhold, whether it's your entire paycheck or maybe the last 2 paychecks of the year, that could vary based on payroll provider, based on your company's policies, but it's certainly something that's possible in some cases. If you were able to accomplish that, the exact same thing we looked at up here would occur. The withholding on the paycheck might actually be occurring out here in Q4, but you're going to get credit for it evenly throughout all 4 quarters. And then possibility number 3 to accomplish this if you are not currently employed, but you do have your own business. If you are a shareholder / employee in an S corporation that you own, in other words, basically the way that this would play out is you run your small business through an S corporation. In that case, you are not only a shareholder of the corporation, but you are actually also an employee of that business. And you would be paying yourself and providing yourself a W-2 in that case. And therefore, you could have the ability to up that withholding yourself on the last few paychecks. I know that this option right down here is probably going to be less broadly applicable because generally speaking, there's going to be more people dealing in brokerage accounts or dealing with employers than there are going to be people running their businesses through an S corporation. However, if this is applicable to you, this is an option that could be available. Okay, last resort method number 2 is to elect the annualized income installment method on your tax return. This method is what we went over earlier in chart 4, how to make this what the IRS actually sees. In other words, we make the election to get all of this deemed income out of the first 3 quarters and back into the 4th quarter where it actually occurred. Note that you can use this method, or this method can be elected through the filing of your tax return, including extensions. So for a return filed without an extension, you have till April 15th to elect this method. And for a tax return filed with an extension, you would have until October 15th of next year to elect this method. And the key I want to point out right here is that this method is helpful if your big transactions or your one-time transactions occurred in Q3 or Q4 of the year. That is what we saw with Fred earlier. He had that $70,000 of capital gain in Q4, and so his big transaction, quote unquote, or the one that is in question, that occurred late in the year in Q4. That is when electing the annualized income installment method could be helpful. Now going right down here, but the annualized income installment method may not be so helpful if your big transactions occurred in Q1 or Q2 of the year. Why is that? And the answer is because the election would push the income the other way, or in the other direction, or into the earlier part of the year. So for example, let's say that Fred's transaction of $70,000 actually occurred on February 1st, sometime in Q1 of the year. Well, then by default, the income would not be $70,000 in in Q1, it would be spread out evenly across all 4 quarters, just like we saw before. But in this case, with the transaction actually occurring in the early part of the year, the annualized income installment method election would take the income out of Q4, out of Q3, and out of Q2, and it would push it all back into Q1. Generally speaking, this is not going to be a favorable result. And it's not a favorable result because hopefully what you are seeing from these last resort techniques is that what we want is to push income out or spread income out as far as possible toward Q4. And then going back up here to the withholding strategy one more time, what we want is to push withholding back or spread it out as much as we can, pushing it back toward the beginning of the year. So just to repeat those two things in summary format, the further we can push income towards Q4 and the further we can push withholding towards Q1, the more favorable results we're going to achieve with these last resort strategies. Now, on that note, last resort method number 3 is to elect to treat withholding as occurring when it actually occurs. For example, let's say you did a Roth conversion or any transaction for which there could be withholding applicable, and let's say you did that in Q1 of the year and that there was $12,000 of withholding associated with it for this example. In that case, the default treatment would be as follows. Going right down here, let's say that we did our Roth conversion on the very first day of the year, January 1st, and we did $12,000 of withholding in conjunction with that transaction. So the withholding actually occurred right here, but the default method for the treatment of withholding is that it's going to get spread out to all 4 quarters, like we've talked about multiple times already. However, with the election to treat withholding as occurring when it actually occurred, what we can do is go out here into Q2, Q3, and Q4 and push all that withholding back into Q1 so that we get credit for $12,000 of withholding right back here in Q1. Now, I wrote right up here that this is the reverse of the previous withholding strategy, and I just want to make sure it's clear what the difference between the two strategies are. In the previous strategy that we went over regarding withholding, the withholding actually occurred at the end of the year. In fact, we intentionally created a transaction or called our payroll department or did something to make the withholding come into existence so that by default it would be pushed back into all of the previous quarters and we could get credit for it. However, down here in the strategy that we are currently looking at, the withholding actually occurred at the beginning of the year. So by default, we were getting this treatment right here, but with the election to treat withholding as occurring when it actually occurred, we're able to push all of that back into Q1 and get the $12,000 of credit here. So to summarize that, both strategies are similar in that they're doing something to push withholding back into earlier quarters. The previous strategy created withholding out here and allowed the default method to push it back. This strategy had withholding occurring up here, but we don't like the default strategy this time because it's pushing the withholding out into the future, and so instead we elect to push the withholding back into the quarter when it actually occurred. By the way, paying underpayment penalties and interest is one of the silliest ways to overpay the government, and it can add up to thousands, even tens of thousands of dollars or more over the course of your life. So if you are planning to engage in any significant income generating activities for the remainder of your life, including Roth conversions, capital gain transactions, self-employment business activities, or any transactions which are one-time or seasonal in nature, I highly recommend that you obtain a thorough understanding of how to apply your number 1 withholding and number 2 estimated tax payment options to both the A safe harbor and B the annualized income installment methods of satisfying your pay-as-you-go tax obligations in the United States. My No Dings Advanced Estimated Tax Training class will teach you how to apply apply these various rules to the following common fact patterns. Scenario 1, estimates based on last year but current year income goes up. Scenario 2, estimates based on last year but current year income goes down. Scenario 3, estimates based on this year and current year income goes up. Scenario 4, estimates based on this year and current year income goes down. Scenario 5, Roth conversion at the beginning of the year and your estimates are based on last year. Scenario 6, Roth conversion at the beginning of the year and your estimates are based on this year. Scenario 7, Roth conversion at the end of the year and we have estimates based on either last year or this year. Then we have scenario 8, which is broken out into 4 parts, starting with annualizing income under the annualized income installment method. Part B is utilizing the annualized income installment method calculator that is provided with the course. Step C is interpreting Schedule AI. Part D is comparing the safe harbor versus the annualized income installment method. And then finally, scenario 9 will be doing the annualized income installment method versus the 2 withholding strategies. Access to the No Dings Advanced Estimated Tax training class can be purchased for a one-time access fee at the link in the description below this video on YouTube. So that's going to be it for today's video on how to save your assets using the 3 last resort methods for shifting income or withholding around throughout the year. Thanks everybody for watching, and I'll see you next time.